Welcome back, everyone, to the Cornerstone Private Wealth Podcast. We're happy to be joining you on a holiday-shortened week. I'm joined by my partner, Brett Hina, for our third episode under this new format. Brett, what's new in the world? June was a pretty boring month, huh?
Yeah, it's been pretty slow this year, Dan. As I mentioned last month, if you were on Mars or something, or out of the country, or not picking up the news for the last 6 months, and you just looked at the beginning numbers of the year and the numbers now, you'd think it's pretty like humdrum, right? If you look, in fact, through today, you just looked at the S&P finishing the first 6 months of the year up about 5.7%. So around the 5% return halfway through the year is really about average, right? Because if you look at the long-term return of the stock market, it's somewhere around 10%, including reinvestment of dividends. So here we are halfway through the year, and the returns are about half of that, about 5%, which is, but we both know it's not humdrum, because below the surface, there's been a lot of churning. In fact, it's a pretty amazing year. If you go back to January 1st, there was a lot of kind of animal spirits coming into the first of the year. And what you had was a big run up from election day to January 1. And that continued for the first about, we'll call it like 6 weeks of the year, from January 1st to February 19th, where the market topped out. The S&P 500 was up about 4.7%. And then what we had after that was we had a bear market, followed by another bull market, all inside of 6 months. So we had about a 20% decline from February 19th down to the tariff day on April 8th. And now we've had something like 28% increase during that time. So that's been amazing.
And we're kind of, it's funny, it is almost like Groundhog Day, because we're kind of right back in that same set of headlines now that we found ourselves in April. Right, we had tensions in the Middle East. Obviously, we've got a different set of tensions now, but thankfully the ceasefire with Iran is holding as of this recording. But tariffs are now right back in focus. Right, we had some positive movement in the markets last week, and certainly some excitement over the weekend, where it looks like there is kind of a more formalized deal with China with some rare earth minerals in there that are going to be unlocked for the U.S. and global markets, and then also some give backs on our end to make that work. But also looks like we're getting closer with Europe in terms of making a tariff agreement. Friday was eventful, where all of a sudden we weren't talking to Canada anymore, and then over the weekend the digital tax goes away, and now that's back on the table. So, depending on how this next week shakes out with tariffs, that could really move the market in a positive or a very negative way. And you kind of add in the fact that we're in the summer months, volatility's light, headlines are heavy, and we could see the market really rip here.
Absolutely. Yeah. In fact, one of the focuses we have for this podcast is to ask some of the more frequent, or answer, I should say, some of the more frequently asked questions that we're getting from clients. And the biggest question we've been getting for the last month has been, how long will this thing last? As far as the market rally, should we trust the rally? So one of the things that Dan and I looked at is try to compare and put this into perspective for clients, to try to compare where we were on February 19th to where we are now, which this podcast is going to drop the first week of July. So comparing, and we made the recent high last Friday, the last Friday in June. Okay, so when you look at things, Mike Santelli, I really enjoy his work from CNBC. He was a longtime Barron's writer. He did a piece on Saturday where he can kind of compared both items. So we're going to pull a few things from that. But if you compare since we had such a strong earnings in the first quarter, if you compare the PE ratios to where we were, we had a rip-roaring double what we expected in the earnings. So valuations are actually slightly lower than they were in February. That's surprising, at about 22 times forward earnings, where on February 19, they were about 22.5. So that's surprising that the PE ratio is a little bit lower.
Yeah, and I think that, when we had the initial tariff announcement, you started to see a sell-off, and people were, ascribing some more value to some of those names. One of the things they also thought that maybe the market was still a little rich, even despite that, was the fact that the expectation was earnings were going to have to come down across the board.
Exactly.
And we haven't really seen that as much, right? You've had stocks really hang in there. And while, last time we were getting together, we were talking about companies issuing two sets of guidance, right? A tariff or a non-tariff version. But but the consumer has remained strong. And as a consequence, company balance sheets have remained strong. So, a whole lot of recession talk last time we got together. You've started to see that kind of temper and moderate, especially among the pundit class, where now you're hearing some of the big firms and come out and say, hey, maybe we don't
Mhm.
expect the second half to be that bad. And a lot of that is driven by the resiliency and strength that we've seen in corporate earnings.
Yeah, and we talked last time, and we're still not sure if there was a pull forward because we did hear companies mentioning that with the tariffs pending
Yep.
in the second quarter, that they were maybe going to do some of their ordering ahead of time in the first quarter. So we're not sure yet how much of that really transpired. But that 22.5 PE ratio or 22 now is still pretty high by historic standards. But if you look at the S&P 500, which is a market cap weighted index, meaning the Apples of the world, the Teslas of the world, Nvidias of the world, they have a much higher percentage weighting. If you look at it on an equal weight, so if you took the S&P 500 and just gave equal weighting to every one of the representative holdings, the PE ratios are more in line with their, we'll call it their 20 or 30-year historical average. So that makes some feel a little bit better.
Absolutely. No, I think that's a great point. Also, some of the market dynamics are a little bit different than
Mhm.
last time we were together. I mean, one of the big, I think, changes has been the steepening of the yield curve since we last talked, and then also the continued weakness in the dollar,
Yeah.
right? And that could have actually, there's a negative component of that certainly, but there's also, potentially some positive tailwinds for companies with a weaker dollar. It's not necessarily always a bad thing, right?
Yeah.
So you're starting to see some of that kind of price into the market also.
Yeah, it's a good point. In fact, I just heard driving up to the podcast here today that the second quarter turns out to be one of the worst, probably the worst quarter for the U.S. dollar since 1973. So it's
That's
down something
incredible.
around 10% decline in the dollar. So that's quite a move. You're right. Oil prices are much lower. If we use that February 19th comparison date, oil prices are lower. And the 10-year Treasury is that was hovering right around 4.5%. Now we made a low for the year of 4.23 today. So
Yeah.
that's also quite a move.
And you think about that too, how close we've come to, if you put yourself back in the mindset of 2022, seems like an eternity ago, and a lot has happened since then. But the initial guidance that was coming out of the Fed at the time was talking about, hey, eventually we're going to get to a long-term rate in the economy of around 3.25, 3.5%. And you're starting to see yields kind of creep back naturally into that run range. While we'll see some cutting, officially on the Fed side, perhaps later this year, maybe even as soon as this month. But you're starting to see the market do a lot of that work too, where we're getting towards that kind of longer term average. And you mentioned something interesting there about oil prices being down. Who would have thought that after the
Right.
month that we just had, right? You know, uh, as recently as a week ago, we're talking about the Strait of Hormuz potentially being shut down,
Right.
and will Israel bomb the oil producing facilities in Iran, and what's that going to do to global supply and price uncertainty? And while we saw that kind of initial shock in oil prices, by the next day we were
Right.
starting to
It's already done.
normalize again. So I mean,
Yeah.
what a whirlwind month! But it's instead of like the old 24-hour news cycle, it
It's
seemed
like
almost
2
like
hours.
2 hour news
Right, right,
cycle. So
right. Yeah, exactly. Now, another thing that you can be construed as a positive is if you look at sentiment and position, it's been very negative. So much more positive, as I mentioned, heading in February on February 19th, the last time we made an all-time high. But I really enjoy Tom Lee from Fund Strat
mhm.
Advisors. He's on CNBC pretty much on a daily basis. People really clamor to listen to what he says. He's been calling this the most hated rally. And Goldman Sachs had a podcast we listened to on Thursday, and they mentioned if you look at discretionary investors and hedge fund investors, right now they've been positioned much lighter in stocks, something like 60 to 70% of their normal long positions the whole way through the rally. So you could have a little bit of a catch-up trade. I have a report in front of me from Deutsche Bank. They looked at entering Friday. They said it's about if you compare hedge fund positioning, it's about in the 30th percentile since 2010. So very, very light positioning. So you have some of the smart money that's been out. And Dan, you follow closely the retail investors. they've been very much in.
Very, very active, and kind of following the old tried and true methodology of buying the dip. You really saw retail step in and
Right.
buy, especially in some of what had been the high flyers, pre pullback. So a
Mhm.
lot of the AI names and tech related names that, this time in April, people were saying, "Hey, have we really, has that trade run its course? Did we get ahead of ourselves?" And you saw, continued great earnings. We had great earnings out of Nvidia and Micron, which kind of reinforced that, that storyline. And all along the way, retail didn't give up. Right? They kept
Right.
in there. They kept buying good quality companies, and it's, maybe it's time to rethink that, smart versus dumb money mantra. But it's been pretty breathtaking to see.
Yeah, and one area we have to address this interesting chart from a Gallup poll that is our first chart of the month, where it looks at, and it's just an amazing. It looks at the where if you slice and dice it with Republicans and Democrats, what they expect for the stock market in just the last 6 months. And they've been doing this study since 2002, and it's the biggest gap ever. It's a 47% gap. What I mean by that is that what they're expecting as far as stocks performing over the next 6 months is very, very negative for the Democrats, very, very positive for the Republicans.
That's shocking. That I can't imagine that we would have such, polar opposites of opinion among the two political classes right now. But no, I think that speaks to the environment that we're in,
Right.
right? Everyone has their own information bubbles at this point in time, and everyone has really closely and strongly held beliefs
Right.
about the direction they think the country's going in. So, the stock market is not usually a leading political indicator or a cultural indicator, but it seems like now it's representative of what's really going on culturally.
Yeah. So the latest numbers from this month show that about 60% of Republicans expect the market to be higher in the next 6 months. This is after the big move. While Democrats, it's about 12%. So it's a pretty striking gap.
Very, very interesting. Now, what do you make of speaking a little bit more about consumer sentiment and kind of where we've been at over the past month or so? We also got some interesting economic news in the form of the May core PCE,
Right.
right? And that came in a little bit hotter than expected. I think up about 0.2% or so month over month, um, which was a little bit of a reversal of the trend we saw.
Right. Which has
Right,
been
and
lower.
how do you think that impacts, or what do you think's gonna, will that have an impact in terms of consumer purchasing, you know, uh, 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 trends that have been going on, or confidence in the marketplace?
Yeah, I don't know about the consumer because one thing about the U.S. consumer is they've proven in the past through. I remember 2018,
Mhm.
we had a rough fourth quarter in the market. The speculation was, okay, Christmas spending is
Yep.
going to come, and it always comes. People spend it even if they don't have it. But I think that really put the Fed a bit on hold. And that's something else we have to talk about because it's really a big question going into the summer. And we saw another letter that Trump wrote to his favorite guy, Jerome Powell, today. So there's a lot of pressure there,
Yep.
and news out today that they might even name. There's an opening on the Fed coming in January, so they might name that person in September.
Yep.
The Fed Chairman Powell has up until next May. His term expires next May, but they may appoint somebody in September, and he'll truly be a lame duck governor if that happens.
Yeah, and you've been hearing, the shadow Fed
Right.
terminology thrown around, and you know, that totally, in my experience, at least, anytime we have shadow anything, whether it's shadow banking or shadow lending or shadow Fed, it
Yeah.
gives the market some pause and a little anxiety. So, well, it's going to be interesting to see how that plays out. Um, but I think, love Jay Powell or hate him, the one thing he has been is excessively or exceedingly clear, I should say, on how he's approaching this, and he does seem to be sticking to data dependence.
Right.
And you can definitely make the argument that maybe they were too slow in the beginning, and maybe now they're too slow on the back end. But he's letting the data, lead him to where he's going, and I think that's the core thing that the markets are operating off of is they kind of know what to expect. They're not getting a lot of surprises. Um, This past, set of Fed commentary was a little bit more dovish,
Hmm.
but we're talking incrementally more,
Right.
right? It's not like we're getting a big sea change in opinions there.
Right. We had a couple of the Fed, Waller, and another Fed member mentioned really bring September in
Yeah.
for the next rate increase, and even potentially looking at July. This podcast will drop in July, so
Yep.
there's a potential there of 25 basis points in July as well.
And I think one of the things that, from a client standpoint, that they don't oftentimes realize as well is that you've got voting and non-voting members.
Right.
And a lot of times you'll see some of the more bombastic commentary coming out of Fed governors where they're non-voting members for that cycle, and they feel a little bit more empowered to speak their mind.
Absolutely.
So you're getting a little bit of that right now as well.
Got it. Speaking of July, seasonal factors, July has been 10 years in a row. It's been an up month. Okay. July has been positive for 10 straight years. I think if you look back historically over 150 years, there's only been 11 times that it's been up, in a row, one time. So we'll see if that happens. And it's been the best month over the last 20 years. You think there's anything important to that stat?
I mean, I think it's interesting, and I think part of that is, the summertime is generally, as I mentioned earlier, lighter trading volume. Things tend to slow down a little bit, but this is one of those years that's kind of jam-packed with headlines. Right. So, I don't see necessarily a reason that's different this year than last year for it to be a, completely different outcome. But at the same time, I wouldn't be remotely surprised, right? We have a lot of data points, especially on the trade front in the next week or so. And, no matter where that settles out, I think the one thing we can all be pretty confident in is tariff rates are going to be exponentially higher than they have been historically.
Absolutely.
And, what does the market do in reaction to that? Right now, I'm kind of inclined to think not too much.
Right.
It feels like they've kind of come to terms with it, but it'll be interesting to see.
Right.
What's your take on it?
Well, I mean, I think it's right now you have what moves the stock market. I've told clients this for years is earnings, right? Over long-term earnings and the economy. But over the short term, sentiment and positioning could do a lot, and what you have is definitely we could talk a little bit about the Circle IPO. You have these animal spirits there.
Yep.
You have a lot of investor participation, individual investor. So that alone could cause it. And then with light trading in July, you could easily see more of a melt up in July. I think we're seeing a bit of that. And it's not just the hedge fund managers that have kind of gotten this rally wrong. When you look at strategists, I'm looking at a report in front of me. If you go back to the beginning of the year, CNBC Market Strategist Survey, where they looked at all the investment banking strategy predictions for the year, the median S&P target for the year was 6,600 for the end of the year, right? Which would have implied like a 12% gain for the year. We're on target for that, but a couple of weeks ago, it didn't look like we were hitting there. The lowest target was 6,500. That's now one of the highest targets. So if you go back after, in April, the slashing that they did of the targets right now, and the median right now is 65.57. So that's like a 4% decline from where we are now, right? So that's changed a great deal.
Yeah, that is it's a pretty stark change from the beginning of the year. But again, you think about all the things that have transpired. Think about different policy decisions that we've made, and even right now, right? How much does the current negotiations that are going on as we speak in the Senate, what ends up happening there with the big beautiful bill?
Right.
What does that do for consumer sentiment and also business climate sentiment? So it's just every day it's almost it's a little exhausting to look at and say, okay, what's the new big headline that in a normal year might be the headline of the year? Now it's the headline of the day or the minute or the week. So I'm not surprised that long-term projections have come down that much. But at the same time, I think you'll see some revisions on the back end as we head into the second half of the year higher, because it just feels like the market has come to terms maybe ahead of where the strategists are.
No question about it. So Dan, so speaking of this positioning and sentiment, right? We have these animal spirits are back. That was a term that a lot of these strategists use coming into 2025, and it's gone away for the last few months. But let's look at this stable coin dealer Circle IPO that came out a few weeks ago. I know you watched that closely. I think it came out at it was priced at 31, right? So it's priced at 31. So it's up. I know it hit 263 last week. I think it's down to, you just
It's
checked,
down like 183 now, but I mean, think
183.
about it.
Yeah.
It priced at 31, opened at 69, finished its first day over $83 a share.
Right.
I mean, we haven't seen IPO performance like that in years.
Right.
And again, crypto related, highly speculative, but it is, it is kind of going back to that bullish, sentiment, and hey, we're gonna try and swing for the fences type of deal, which we haven't seen through the first half of the year. Certainly last year was kind of more true with AI,
Right.
similar sort of sentiment in the prior year. But yeah, what do you make of all that?
I think it can always go further than you think. Remember when on the Reddit, boards in a couple years, even forgetting what year is that. I think maybe 2021 when that occurred with GameStop.
Oh yeah. Meme stock mania.
Meme stock mania just went way further than you think. But I think about when you see these pullbacks and you see days like Friday when when Circle went up to 263, and you look at it's trading, tremendous number of shares. So there's a lot of people getting in at a high number.
Yep.
And then that money can come out pretty quickly. That's how it's down $80 in a very short period of time. So that is not for the faint of heart. It's not a good way to live over a period of time. You look at the people who bought into GameStop in hundreds of dollars, right?
So you're thinking maybe not the primary piece of a well-diversified portfolio.
No, it's something to stand by and talk about on podcasts, but not really I wouldn't participate. And then you'll have people buying those types of stocks on, margin, people buying options when they're traded on those types of companies as well. And that's just, amplifying the leverage, which is not a great idea.
And I think people think, they look at the stock price appreciation of that, but then they don't stop to consider for a second too. You're talking about a company that IPO'd and by the end of its first trading day had a market capitalization that's bigger than some of the kind of longest and most successful U.S. brands. So it is really incredible, these sorts of moves. And I don't want people to think that that's kind of a normal market reaction, right?
Right.
Definitely promising a technology and an important part of the crypto market. But, there's definitely some pent-up demand there.
But as far as the markets in general trading at all-time highs, when you look at it historically, believe it or not, buying when the overall market hits an all-time high has been better than average. It's been a good strategy. So I'll go to chart number 2. If you look here, what you'll see is that if you look at the S&P 500 trading from 1950 till last Friday, you've the number of all-time highs since the number of all-time highs. If you bought during when the market hit an all-time high, believe it or not, over the next 3 months, it was about equal. You had about a 2.4% rate of return compared to 3% on average. But over a year, 2 years, 3 years, and 5 years, you actually have outproduced the average return. So that's pretty amazing statistic. And I think that speaks to the momentum in the market. People get in late, they get in high, but they sell higher. So
does that mean the old maxim of buy low, sell high is dead? Is it now buy high, sell higher?
You never know.
It is very interesting to see. And that would be something that, you just on its face, you would think it's wrong. Right. But it is incredible. And it's also interesting too, the number of times that these all-time highs end up setting an actual floor in the market. Right. So we had a really serious sell-off through the month of April. But yeah, we are now right back in the thick of things. And it looks like today's no exception. It looks like we're kind of on track for another potentially all-time high close.
Yeah, two days in a row It'll be a third day in a row.
Yeah.
So that is great. So let's shift a bit to the Fed, because if we knew where the Fed was going to move over the next 6 months, we could tell a lot about where the stock and obviously your bond market return would come from. And we had a little bit of a shift in the latest Fed meeting last week, right? Because 7 of the 12 voting members in the Fed see no rate cuts at all this year, okay? But a handful want to move a bit faster, okay? And 2 of the loudest voices are really pushing for action. I mentioned Christopher Waller, Fed Governor Waller, and then there's Michelle Bowman, and they're both Trump appointees. And you wonder, is that a little bit of a positioning? I know Waller's name has been mentioned as potentially one of the next, Fed governors. So you wonder what how that's going to go as far as positioning, because Trump is putting pressure on these folks, and now he's going to name somebody in September. Are they lining up? Do you think they're lining up for a rehearsal, job rehearsals?
Yeah, well, I think yes, to a certain extent. And it was funny too. I was watching CNBC earlier today and saw some of the poly market betting. So your leaders right now in poly market are Kevin Hassett, right, who's the president's top economic advisor. To your point, you also have Kevin Warsh, Judy Shelton, Scott Bessent, which it's very, very interesting to see. But yeah, I do think there's a degree of positioning, right, where people are kind of jockeying for that, and I think that's true in a lot of certainly last Trump administration, and certainly this one, that kind of towing the company line, so to speak, in terms of your public remarks seems to pay serious dividends in terms
Right.
of government appointments. So I wouldn't be surprised by that in the slightest.
Great. Yeah. And put it this way, if you're putting your name up for the job, I think you're going to have to give some kind of signal that you're willing to cut
ball.
rates
Yeah.
pretty quickly, right? So let's talk, because I don't think we covered the third slide here. It's just the sectors that have moved since the market low on April 8th. And what you see is technology has been leading the way. It did lead the way down in that bear market. So again, we had a 5% gain in the beginning of the year. Then we had a bear market. The definition of a bear market is a 20% correction. We did have intraday 20% correction, although on a closing level, it's something like 19.5. Technology led the way down, and it certainly led the way up. Since April 8th until the end of June, you have tech up about 40% from the low levels. Communication services was second, almost 30%. Industrial is another big area, up 25%. Another area that's been a standout is financial.
Yep.
So the question would be, for the second half of the year, do you see that holding?
Well, I think, I'll pick on the last one in terms of financials. I think some of the kind of loosening, I would say, of capital restrictions that we've seen over the past couple of days, I think is a significant tailwind for financials moving forward. But that sell-off was unlike many in that, normally you would see a flight to quality. You would see a lot of treasury purchases. You would see people reposition their equity portfolios and buy more defensive type stocks, consumer staples, healthcare, et cetera. So I wouldn't be surprised if there's a little bit of kind of reversion to the mean in that front. I mean, we've seen, again, this is broader. The market has broadened out to a certain degree. You've seen value stocks do better than over the past couple of years, but still underperform growth significantly. Would I be surprised to see the growth train keep going? No. On the same token, I wouldn't be surprised to see value start to pick up a little more momentum as people take some, short-term gains off the table, but want to stay invested in the markets.
Yeah, and I think that's healthy, and we're definitely seeing that. If you look at year-to-date gains, you have value and growth are pretty close, although value growth is making a dramatic comeback, but it's, for the last couple of years, it's been all growth. So it's good to see value pretty much equal. And you're seeing a lot of some of the big name strategists. I saw Rick Reeder. He was on big bond guy he's at BlackRock.
BlackRock,
right?
yeah.
BlackRock. He's really, he's chiming in on the stock market. He's expecting it to surge in the second half. And his big thing is just the spending in the AI
Hmm.
revolution, an AI that we haven't talked about in a few months. And that's something that he thinks will bring down inflation. So your thoughts there on the AI spending?
It's a little bit different than the past couple of years, right? It's more AI R&D. We're seeing more in the models, less on the infrastructure side of it. Um, but yeah, no, I think AI spend is going to continue. It had a little bit of a pullback there in the first half of the year. It started to slow, but I think now the race is really heating up. I mean,
Right.
we just had that
It really
story,
is.
what, last week or 2 weeks ago in terms of Meta approaching Open AI,
Right.
scientists and basically offering them, what, in one case, it was $100 million to
Right.
swap companies. So I think there's a real understanding there that the kind of race for super intelligence uh, is still red hot,
Hmm.
and somebody wants to be the victor, and they're not stopping, in terms of spending. But the data center build out and things like that, maybe that starts to slow a little bit.
Hmm.
But on the flip side, the energy needs of the country can, conceivably keep going up month after month. So I think you might see, different capex, right? You might see more expenditures in terms of, again, something like a 3 Mile Island. Microsoft has a deal there to bring some more power on the table, but you might see more investment
Hmm.
that way as well. So my personal opinion is it keeps going and probably accelerates, just not to the same level that it did, maybe a year or two ago.
And there's offshoots, right, of AI. If you have the AI build out, then you have cybersecurity related
Yeah.
to AI, and there's a cycle of spending there.
And then you have all too we think of AI almost exclusively as this really high tech enterprise, and we're thinking about the tech companies specifically, but think about all the really boring industries
Right.
that will gain incredible
Exactly.
efficiencies from the use of AI.
Right.
Um, so that's where I think you get the next kind of level of spending and growth coming in. It's like, how do we, produce, a better client experience? How do I process transactions in my business more efficiently? How do I, something like a restaurant, how do I optimize scheduling for my employees? All these sorts of
Right.
things that start to trickle downstream into other parts of the market. I think that keeps it going.
Right. So if you tie it in a bow for clients right now, you have the traditional, we'll call it the 60/40 portfolio. And as we stand now, and again, dropping this podcast in the first week of July, we have at least the month of July, as far as we can see, looks pretty decent. We have
Mhm.
good, strong positioning, good, strong sentiment. On the bond side, we have the Fed is going to lower rates at some point. There's really not much of a risk of rates increasing. And remember, in your bonds, what happens is you have from a total return standpoint, if interest rates go lower, you pick up the coupon on your bonds, and you also get a total return above your coupon. So you take for example, say a 5% corporate bond. If rates go down over the next couple of years, you could have a 6.5, 7% return on that bond because you'll have some appreciation. So the 60/40 portfolio looks pretty good, right? Going forward between now and as far as we can see, which might be the end of the year into 2026. When you consider also that if you look at the earnings estimates, we're going to be fast and furious with second quarter earnings starting next week. The financial companies always come out first, and we're predicting a pretty strong, or at least the market pundits are predicting a pretty strong quarter for earnings. So if earnings hold for the second, third, and fourth quarter of the year, could be a good year.
Could be a good year. And the other great value that we've talked about so many times with the 60/40 portfolio, but it's as true as ever, is just that it it provides you ballast and comfort in uncertain times.
Right.
And that always reminds me of a great Warren Buffett quote, which is, the most important quality for an investor is temperament, not intellect. And if you can have a portfolio that helps reinforce kind of that calm temperament and demeanor
Hmm.
during uncertain times, you're going to do better longer term. And summer's going to have no shortage of headlines. I think it makes sense to have a portfolio that's a little bit more all weather.
Speaking of Warren Buffett, you wanted to share. He made some news again this month, right?
Big charitable
Yeah,
donation. What was the figure? Six
6 billion.
billion.
Yeah, 6 billion. If you look at it, he's
Yeah.
given something like 60 billion over the last decade. So he's really starting to, and that's a testament to him and his performance and his fund for many years.
Now I know early on in the month of June, speaking of Warren Buffett and kind of Berkshire, there was a little bit of a question mark in terms of, has Berkshire now lost its its
Right.
luster to a degree?
Right.
Is the Buffett kind of premium, going to get
Yeah.
washed away? What do you make of that? What do you think of that moving forward?
I mean, he's smart from a transition standpoint. It was a kind of a surprise that he announced his successor at the meeting, but they've been working by side for many years.
Yep.
And I think, if you look at it by all accounts, a lot of the portfolio decisions have not been solely made by Warren Buffett for many years. So although he's still working, I think it's 93 years old. He's not working near, as self-proclaimed, not working near as hard as has been before, in previous years. So I think that's
Absolutely.
good. So let's talk about now what could go wrong, right? Because now we're sitting here again. I keep saying it's the first week in July, but also isn't there a thing happening on July 9th? Don't
Yeah.
we? Wasn't there a 90-day extension to the
Yeah.
tariffs? And that deadline is going to be coming up. Although um, President Trump did signal some flexibility with that, but
Yeah.
the tariffs are. What do you think about July 9th?
Well, no. So I think that is kind of the biggest tail risk we have in the near term. Um, it seems like, if we're just looking at the size of a trade partner, right? It seems like we're going to have a constructive outcome with China. It seems like we're going to have a constructive outcome with the EU.
Mhm.
Uh, Canada, it seems like maybe we could get there again, but Japan's really that kind of big trading partner out there where you really haven't seen a lot of positive news out of that. And I think the president was quoted the other day saying something to the effect of, well, they'll get a letter basically just telling them what the deal is if we
Right.
can't come to something. And that to me is, that's a big concern,
Right.
right? So I don't think, I wouldn't sleep on that July 9th deadline. But, it could be more of the taco trade, right? In terms of we get there, we get right on the precipice, and all of a sudden we get another extension.
Yeah, and here's the chart that we've shown a couple times in our webinars and podcasts. You go back to 125 years, and you can see the history of tariffs, and you can see that big boom in the 30s, part of the Great Depression. And then last month we showed the maximum tariff chart, and this is on April 8th. And you can see the blue line. It's a lot less, but it's still a lot higher than historic levels. So we're still trying to come to grips on, is there an inflationary cause there? We also had surprisingly large amount of revenue over the last couple months on tariffs.
Yeah.
So in the beginning, when this rolled out, certainly on April 8th, I think a lot of analysts were expecting a lot worse, and now I think they're expecting a lot better, right? So if that comes in, if the tariffs come in higher than expected, we could be back in the soup again.
And it also, too, if you look at something like what they did with the UK, but there's also a lot of devil in the details here in terms of, are there carve outs or quotas contained within these tariff rates? So, let's say an example that there's a 10% universal tariff rate issued against the EU,
Right.
but then there's all these little carve outs for, okay, well, as long as the quotas for, fine wines are at a certain level, or auto products or aluminum or what have you,
Right.
you're not going to end up paying that tariff rate. I think that's what we still have to see. And my suspicion is that, if he can keep the headline number high, but then really kind of bring it close to maybe a little bit, it's tilted in our favor, but it's more status quo than what we would have expected. I think that's a very positive outcome for the markets. And given how he's acted so far on a tariff front, I wouldn't be surprised to see that in the slightest.
Absolutely. What else could go wrong over the summer?
So continued Fed uncertainty, right? We talked about the shadow Fed there a couple of moments ago, but I think that is a big potential overhang on the markets. In addition to that, weakness in housing and potential, again, we're starting to continue to see some cracks in the labor market. So, if you've got a continuation of inflation pressures, continuation of weakness in certain areas of the housing market, and then you start to see, jobless claims really ramp up, that's a big potential catalyst for the market.
Yeah, I also worry, I think a fear out there would be, the expectations are there that inflation is going to kind of go down in a linear
Mhm.
fashion. And it can be it can stay for longer than expected, right?
Yep.
And it could be, that could be frustrating for the markets if inflation comes back or lingers longer. It certainly will put the Fed on pause, and if it puts the Fed on pause, you're going to have more tensions between the White House and the Federal Jerome Powell.
And let's not forget, again, we have a tentative peace right now in the Middle
Right.
East, but
Geopolitical, yeah.
there is also, if there's anything we know through our history, over the past 20 years, that is the potential to be a really volatile and expanding conflict. And right now, again, it's like the coast is clear in the short term, but that could change
Right.
rather quickly. So, you know, I wouldn't say we're out of the woods by any stretch of the imagination, but it seems like we've settled, at least in the near term, into a bit of a holding pattern. And, over the next 2 weeks, we're going to see how that develops.
Yeah, and so what we're focusing on the portfolios is just to have quality right
Yep.
now. So I think if you look at it, companies without earnings right now, it's probably not a great environment for that, because there's plenty of companies, and that's
Yep.
part of the reason why tech has been such a great leader, because you have some pretty strong profit margins there. In this environment, when quality is doing well, it's why take a shot with companies that aren't profitable. So our focus is going to be on profitable companies, good long-term portfolio managers, and having a smart balance between stocks and bonds. Maybe you have a higher percentage in stocks now than your strategic portfolio would dictate for the long term, but you don't go overboard. You don't go leveraging and margin and go 100% stocks. You still have to be reasonable.
Yeah, exactly. And it's, I know you preach this to clients on a daily basis, but it's just staying focused on the long term, staying disciplined.
Right.
You're not trying to chase returns and say, oh gosh, I missed the bottom on April. Now really need to change my risk profile. No, it's sticking with your plan, focusing more on that, less on the news feed. And I think you come out of the summertime in a pretty healthy position.
Great. Any final thoughts?
No, just, just enjoy the summertime, enjoy this kind of short-term respite we have to really double down and focus on family and friends and what's really important in life, and turn off the news. It would be what my best advice.
Yeah, and, as I said, 4 or 5 times, that we're dropping this on the week of July 4th. So use the 4th of July weekend to be a little bit grateful, right? And we have from a stock market standpoint, we have half a day on Thursday, right? So that's pretty good. The stock market closes at 1. You have Friday off, so hopefully a lot of people will be off on Friday. Hopefully you can leave a little bit early on Thursday and just enjoy family in the weekend. And we appreciate we make these podcasts for our clients. I said it last time, we weren't making these podcasts to be the next Joe Rogan. We're designing these podcasts to really just answer some of our clients' more frequently asked questions. So we would just want to thank our clients for their trust and confidence, and we will see you next month. Thank you very much.
Take care, everyone.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.